the best thing to do is to get rid of the big banks. If they are systemically dangerous, they should not exist, period. So the answer to the dilemma of uh, Chase is it should be shut down. Okay. Don't try to increase the capital ratio, just shut it down. Say you are too dangerous to exist. We cannot have a $3 to $5 trillion bank. We're not going to allow it. Set a cap.
Hello, everyone, and welcome to another Class Unity Speaker Series event. Class Unity is a Marxist organization that supports class politics here in the United States. We believe in class politics, not identity politics. Our ultimate aim is to help build a coalition that would establish a workers' party here in the United States. If you would like to support us, please consider giving us a donation, or even better, by joining us. You can do either by going to our website, classunity.org. In addition, please subscribe to our channel, hit the like button, and share with your friends. Our political education program is concerned with promoting materialist analysis of politics, economics, and social issues. Part of that program is our speaker series. And so for the main event, we will be speaking to Professor L. Randall Wray. He is a professor of economics at the Levy Economics Institute of Bard College. He is one of the developers of modern money theory, and his newest book on the topic is Making Money Work for Us. Professor, thank you so much for coming to speak with us today. Our group has read some of your articles on the 2008 global financial crisis. So if we could just start, could you share with us your perspective, your view on the global financial crisis? What caused it? What was the role of the Fed's bailout of the financial institutions? And in your view, what are the lessons that we should have learned, but we did not?
Okay. So yeah, that it was a long time ago, almost 20 years. And can you let me share the screen? I have a very quick PowerPoint that just hits, I think, every question you raised very quickly. And then we can get into the details as much as you want and as much as I can remember.
Sure.
Um, so let's begin. Outline of the causes of the crisis. When the crisis hit, uh, everyone used the term, this is a Minsky moment. And there is some truth in that. But as I will argue in just a second, I think it's better to look at this as sort of the final stage of Minsky's stages of capitalism approach to it. It wasn't just a moment. It was sort of the end of the game of a 50-year transformation of our economy. The main causes were financialization of the economy, layering of debt on debt on debt. And then it began as a liquidity problem, but that liquidity problem uh, was sort of at the top layer, and underlying it was massive insolvency. Um, it resulted in part from shredding of the New Deal reforms that had kept the financial system safe for a generation after World War II. Bubbles and the Goldilocks economy under President Clinton and the movement of the government's budget. I'm not going to say too much about this, but if you want to go into that in more detail, I can do that. And then finally, fraud and the real estate bubble. So, what is the Minsky moment idea? Minsky, beginning in the 60s, started developing this, what's called the financial instability hypothesis. And the argument is that over the course of a cycle, the economy moves from a fairly robust and stable financial system to an increasingly unstable, fragile system. And then that finally results in a financial crisis. Okay. And that was based on his addition to Keynes's general theory. In the general theory, the business cycle is created as a result of investment. Investment is the driver of the business cycle. Okay, so that's the general theory approach. But it didn't really have a theory of how you finance investment. So Minsky always argued what he was doing was adding a financial theory of investment to Keynes's investment theory of the cycle. And so the economy goes through these profiles where a particular profile dominates. In the early post-war period, the profile that dominated was hedge. This is where you can service your debt, you can make the interest payments and pay back part of the principal. And in part because the financial system was so full of very safe government bonds at the end of World War II and hardly any private sector debt, we had hedge finance. The other reason was because everybody remembered the Great Depression, no one's going to take major risks. But over time, he argued, the financial profiles are going to change. We're going to get more speculative positions. Those are positions in which you can make the interest payments, but you can't pay principal. So this must be based on expecting your income to go up so that you can pay back the principal too. And then finally, two Ponzi positions where you can't even make interest payments. You got to borrow more to make interest payments. So your debt is growing and potentially explosive. And as the system gets more fragile, we have a crisis, but the big bank, which is the Fed, and the big government, which is the Treasury, come to the rescue and save the system. But the problem is, every time you're successful in saving the system, the risk will grow. So stability is destabilizing, is his most famous saying. Okay, but if we look at our recent, and by recent, I'm talking about beginning in 1980, our recent crises don't fit this at all. We had, and I'm willing to talk about these in more detail if anyone is interested. I studied the thrift crisis in great detail. It's extremely interesting what went on, and it was pretty much replicated in the global financial crisis, but at a scale 100 times bigger than the saving loan crisis. But anyway, it was all about commercial real estate and developing country debt. Okay, so it was not about investment. So it did not fit the financial instability hypothesis. Then we had also in the 80s the LBO, uh, Michael Milken and Jug Bonds, and that led to a crisis in the financial system. In the 80s, sorry, in the 90s, we had the new economy and NASDAQ bubbles, what Greenspan called irrational exuberance. That crashed at the end of the 90s into a recession. But we got out of that very quickly because we had three bubbles: residential real estate, commodities markets, and the stock market, which I did not put on here. But three bubbles, biggest bubbles in human history without question. And then those things crashed. But the point is, none of these had anything to do with firms investing and getting into trouble because they borrowed too much to invest. So it does not fit the Minsky moment, which was Paul McCulley's term that I think he came up with for Japan originally, and then he applied it again here, but it really does not fit. All of these follow a pattern, and each crisis is worse than the previous one. So it's better to look at Minsky's later work or at his earliest work before the financial instability hypothesis, where he took a stages approach to the evolution of capitalism. And this was more similar to his own professor Schumpeter's view of capitalism and evolution of the system over time. So we had, back in the 19th century, we had commercial capitalism, and each form of capitalism has a dominant type of financial institution. For commercial capitalism, it's the commercial banks. Then we have the rise of finance capitalism, where the investment projects become too expensive to pay out of retained earnings or family funds, you have to have investment banks. So investment banks are the financial institutions that are important under finance capitalism. This is very similar to Hilferding. That crashed in 1929, and it was replaced with paternalistic capitalism, or Minsky also called it managerial welfare state capitalism. So managerial, where the government works with labor unions and with the biggest corporations to sort of plan the economy, and welfare state because we have put in place a social safety net. But the relative stability of that system, Minsky warned in the 50s, is going to evolve to another kind of capitalism. And he called that money manager capitalism. Now, many other critics of capitalism have come up with a very similar view of what this is all about. Jamie Galbraith called it the predator state. Many people, especially Marxist leaning people, called it financialization of the economy. Even Bush Jr. had a name for it, the ownership society, which put a positive spin on it. Neoliberalism, neoconservatism, or shadow banking, as Paul McCulley called it. So, what is the pattern? The stability breeds instability. You get accumulation of financial assets and liabilities. You have globalization and securitization. Minsky argued you could not have had globalization without securitization. So we had this strange phenomena that the Central Bank of China owned United States home mortgages. That couldn't have happened without securitization. So we spread the vector all over the world because of securitization. The idea was you don't need to know anything about US real estate markets because you can get a diversified portfolio by buying home mortgage securities. Okay, and then finally, many people say that it was de-supervision and deregulation. No, it was self-supervision. This was actually the policy that was pushed by the Basel agreements. You big, far-flung financial institutions are far too complicated for anybody to regulate. So please supervise yourself. Okay. And so that's what it came down to. All right. And just some evidence of what was going on. This demonstrates Minsky's point. So we have a decline of the importance of commercial banking from about 60% of all financial institution assets to about 20%. Savings and loans is the yellow, and you can see how they virtually disappear because of the thrift crisis. And then finally, managed money is what takes up the slack. So managed money becomes the dominant form. What is managed money? University endowments, pension funds, wealth funds for sovereign wealth funds. So things like that. Managed money under professional money managers, where you have to beat the average. That's the important point. Every money manager has to beat the average or they lose all their clients. And so you've always have to push the envelope to increase your earnings. How can you increase your earnings? Well, you increase leverage ratios. You layer debt on debt. So we have there are different definitions of financialization, different ways of measuring it. Um, a good way to measure it is a rising share of profits and value added that goes to the financial sector. So I'll show that picture. I could present data on the other ones too. Layering debt on debt, positions in assets, financed through short-term borrowing, overnight borrowing in the case of the global financial crisis. What really triggered the crisis was overnight commercial paper, overnight, so that every morning the banks had to refinance their positions in assets. And as soon as there was any scare that maybe the bank was in trouble, they could not refinance their positions. And they're dead. In one morning, they're dead. And then speculation. So here's some data on the financial industry share of corporate profits and of value added. And you can see that both of those increased tremendously. So corporate profits before the global financial crisis they were getting 40% of all corporate profits. And if you think about how crazy that is, finance is supposed to be an intermediate good. It's not the final good. It's like, the tire on a car. Okay, cars don't really work without tires, but the tire maker should not get 40% of the profits from cars. And that's what the financial sector is doing. And value added also increases. Speculation, here's a measure. Right before the Great Depression, stock market crashed 29. The average holding period of stocks had fallen to 1 year, which tells you that the dominant uh, participants are speculators, because you have a lot of, you know, elderly widows and so on who never sell stocks, right? But we get the average holding period down to 1 year. We did the same thing before the global financial crisis. So it's clearly dominated by speculators. Then we had the support for all of this in the hands of the Fed and also the Treasury. But the stock market are speculators in the markets, not just the stock market, commodities market too, said, look, we don't need to worry about anything because Uncle Greenspan is there and he's going to bail us out no matter what happens. Bernanke called it the period of the great moderation. You don't need to worry because central bankers are in control and we're not going to let anything bad happen. And as soon as you tell markets that, of course, they're going to go crazy. So they promoted this speculative activity. The reality was, by the way, in March of 2007, or April 2007, we had a conference at the Levy Institute. We had uh, Mishkin, who was on the board of governors, and we had two Fed researchers who came to the conference. The two Fed researchers, April 2007, said there are no problems in the residential real estate market. There is no bubble. I gave a presentation, a couple other people from Levy gave presentations. Hold it. We're in the biggest bubble humans have ever seen. Okay. But the Fed was still either completely clueless or just lying, just trying to keep it going. So, anyway, biggest debt, equity, commodity, and real estate bubbles in human history, propped up by the big government and big bank. Securitization, what's that all about? The basic idea is you pool a bunch of debt, mortgages to act as collateral for securities. This was given a big boost by Clinton's budget surpluses, which might sound strange, but the markets did not have enough government debt. And Clinton went on TV and said, we're going to retire all the debt. Okay, we're going to run budget surpluses for 15 years and retire all the debt. And so you can watch him, Google it. You can watch him when he gives this presentation. The whole audience stands up and cheers. Okay, we're going to retire all the government debt for the first time since 1837. The government won't be in debt. Cheering, cheering, cheering. But the financial markets went crazy. Hold it a second. That underlies the whole financial system. What can we find instead? Well, mortgage backed securities. And in the beginning, of course, what they were securitizing were the mortgages of, nice middle class white people in neighborhoods with rising prices. The problem was there wasn't nearly enough of the product. And so they kept pushing the envelope to try to increase the quantity. So one way to increase it was to lower the standards for what could be securitized. But the other thing to do was to tranche the mortgage-backed securities and get many more products out of them so that you get riskier tranches for those who want to take risk and get higher return. And then you could start just creating virtual reality securities that are basically bets on which direction the actual securities will go. Okay, so CDOs. So you get all sorts of product that can go into portfolios to replace the government bonds. Um, the underwriting standards deteriorate, and this is on purpose, uh, from low doc to no doc to ninjas, which you actually could go online and find a ninja loan. So some of my students went and they found them. Yep, they advertised them as, and that kind of loan has to be fraudulent. It has to be. The new home finance model was sold on the argument that it's more efficient. It's much more efficient if you don't actually have a loan officer, okay? Because that's just a middleman. And what we can do is we can just use credit scores and other methods that don't require actually sitting down. So you can just get your mortgages off the internet. So anyway, what did it actually require? You had to have a loan officer, you had to have a bank teller, you needed a home appraiser, and then you needed a public recorder because all the transactions were recorded and are there in the public record. Okay. Then the loans were held to maturity. Okay. That's all it took. The new, more efficient Wall Street model requires a broker, appraiser, lender, servicer, MERS, which I'll get to, securitizer, credit rater, rocket scientists that develop the models to price these things because there really is no financial instrument that is harder to price than a 30-year fixed rate mortgage. Seems counterintuitive, but they're very hard to price because you don't know when the homeowner will refinance. Okay. Um, so then we've got the models, we've got the trustee because every mortgage-backed security is supposed to have a trustee who keeps those safe. CDOs, squared and cubed, CDSs, credit default swaps, monoline insurers, which is private insurance, investors, traders, accountants, lawyers, lender processing services. And then when everything goes bad, you have the robo signers, the Burger King kids who would sign documents committing perjury, claiming they had seen the actual documents, okay, which didn't exist. And then document recovery services. The model was originated to distribute, pump and dump, foreclose, and then resell. So it seemed like a good plan. But the problem is, every one of those steps requires a fee. And almost all the fees are paid before any homeowner makes a single payment on the loan. Okay. And so that was the problem. It's not more efficient, it's much more expensive to run the system that way. Okay, why the complexity? The model was flawed from the beginning, could not have been profitable. The interest payments could not recover the costs. You needed mortgages at 120% of value to book the fees that have to be paid up front. The complexity, as my colleague Bill Black argued, is essential because accounting fraud is always going to be involved, and you have to make it complex to make it hard to see where the fraud is. So it's on purpose. Everyone was rewarded by throughput. The beauty of a casino is the house always wins. We had $10 trillion worth of homes and tens of trillions of dollars of bets on them. Foreclosure was inevitable. In fact, it was the desired outcome because then you can bet on the failure, get the foreclosure. You need to take the house away from the people, and you need to quickly sell it again in order to hide the fraud. If you've read John Kenneth Galbraith's book, The Great Crash, you know that there's a chapter in the book called Goldman Sachs. And he goes through what Goldman Sachs did in the run up to 1929, and it reads exactly like this. And of course, Goldman Sachs was heavily involved in this one too. And they just repeated everything they had done in the late 20s. Bailout and cover up, no criminal prosecutions of top management. Uh, after I wrote those papers, Bill Black and I got in an argument with one of the vice presidents of Bank of America, who because we were saying stuff like this. They're all criminals. They should all be prosecuted. And she was arguing with us on Huffington Post. You can find it. And we were saying it's all criminal behavior, it's all fraud. Anyway, she got prosecuted. She was the only one that I know of. She was jailed. It got overturned and she walked out free. So anyway, there was one, but she walked out. Anyway, we got the stimulus of 800 billion. Obama said we ran out of money. The Treasury said we can't possibly get any more money than this. Uncle Ben, it's all up to you. We have no more money. And they knew that they needed more. It was very clear uh, that I was with Jamie Galbraith. We were trying to come up with a proposal that he was going to push into the Obama administration. And so we were actually literally sitting in the room trying to come up with a number. He got a phone call. He said, "Oh, they say it's going to be 800 billion." He said, "Why 800?" He said, "Because it's not 1 trillion. There is no way Congress uh, will allow a trillion." So anyway, 800 billion wasn't enough. We found after the release of the data that what the Fed did was spent and lent 29 trillion. So that's what it took to turn things around. Here were the totals. This must be in one of the papers. I don't remember. Uh, but you see, it's a mixture of the biggest American banks plus some of the biggest foreign banks. And the this is only the banks. So it doesn't include foreign central banks, which was 40% of the 29 trillion. So this is only the amount that went to private banks. Okay, what were they trying to do? Save money, manage capitalism. We can talk about. Uh, I can't talk in detail about what actually went through Dodd-Frank because I never took it seriously. There was nothing in there that was going to make any major difference. And it's very clear that what happened was we just rebooted the system. There's been no major change. And we are as vulnerable as we were before that crisis. Let me stop now and take your questions.
Uh, yeah, thank you for that. If you have a question for the speaker, you could raise your hand or go and stack. If I could kick the discussion off, Professor, I wanted to note a recent headline last week in which Jamie Dimon is quoted saying it's time to fight back against regulation. And he seems to be talking about capital requirements, card payments, open banking, as they relate to the Basel III endgame. So I don't know how directly that relates to the regulations that you were speaking about just now, but I was wondering if you could comment on that.
Yep. So he's pushing back. They had already reduced the increase of the capital requirements on the biggest banks, which are called systemically important. But as Bill Black always said, no, systemically dangerous. These are the most dangerous institutions, and that's why they want to increase the capital ratios. So originally the plan was to increase it by 19%. The Biden administration has backed that down to 9%. So they already got something, and now Diamond is saying we won't even accept that, right? And let me say, one of his points was that the risk categories, he says, are ridiculous. Okay, now the it is extremely complicated, and the way they treat some things, I'm sure, uh, could be argued about. I don't know the risk categories now, but I wrote a piece on the Basel two, uh, 15 years ago, I think it was Basel two. Um, and it's true that there there are some nonsensical um, ways that risk is treated. It's extremely complicated. Like you might think that it's a 4% capital ratio. No, they have risk adjusted capital ratio. So it depends on the risk class that different kinds of assets are put into. And so, which leads, my argument back then was it leads immediately to gaming the system. What are you going to hold? The riskiest thing in every single one of those classes, right? So that you can get higher returns. So I think there's some room for agreeing with Diamond on maybe some of the risk classes don't make sense. Okay, so that's something you need to negotiate and work on. Inconsistencies in the liquidity rates, he said. He also argued that uh, banks are treated differently from the shadow banks. Okay, this is true. This has been a 40-year problem, now 60-year problem, uh, that we regulate according to what kind of institution it is. So we used to have commercial banks and we had investment banks. Commercial banks could do this, investment banks could do that. And then we had things that were neither of those, say money market mutual funds. Okay. And they're all regulated differently, even if they do the same thing. Okay. This is a legitimate complaint. Minsky always argued you should regulate by function. So anyone who issues anything that sounds like it's a deposit will be treated the same way. Okay. They can get FDIC insurance, but we will tell them what kind of assets they can hold. Okay. That makes sense. So again, this could be a legitimate complaint. And when you look over the past 60 years, there are periods where the regulated banks have the advantage. And then the shadow banks will invent some new product and they've got the advantage. And then the regular banks go to the regulators and beg to be allowed to do the same thing. They say, look, we have to compete with them. And if the regulators say no, they take it to court and they always win. And the reason is because the law is so favorable to the banks. Basically, it says that if it's closely related to the banking business, they should be allowed to do it. Okay. And so you can always find an argument, no matter what the business is, it is somewhat related to banking. For example, Goldman Sachs wanted to corner the market on aluminum, and they did. Okay. Now, is aluminum a banking business? Budweiser could not get aluminum to can their beer. All the Goldman Sachs was doing was trying to monopolize so they could jack up the price. They bought the warehouses for aluminum and the shipments declined by like 90%. Okay. They were just storing the aluminum to jack up the price. They won the court case. Okay. Why? Well, because they're involved in the futures markets, financing futures markets. And they said, look, the more we know about aluminum, the better we can do in the futures markets and in the financial markets. And the judge bought the argument. So there's nothing that a bank can't do by that argument because it's going to be somewhat related to banking, right? So anyway, uh, the banks then are allowed to do it, and then they get the advantage. So then the shadow banks invent something else. So there's always this jockeying going on. And the only way to stop it is to say, look, this is what a bank can do. And this is what we will allow the shadow banks to do. And we're not going to let them compete. So we're not going to let them issue anything that looks like a deposit. Money market mutual funds are 4 or 5 trillion, at least up to the global financial crisis. and they competed directly with deposits. And then, of course, the uh, the Treasury had to guarantee the money market mutual funds because we had a run. The whole crisis started with a run on the mutual funds, money market mutual funds. That's where the crisis started in that market. So what happened with Silicon Valley? Silicon Valley has insured deposit, but mostly uninsured deposits. Okay, so we let banks have both kinds, and you get a run on the uninsured deposit. What did the Treasury have to do? Oh, well, we'll insure those too. Okay, now this gives a huge advantage to the big banks because if you're a not for profit and you've got $500,000 that you need to hold in a deposit, you're going to put it in a big bank because you know that the Fed and Treasury will never allow a big bank to fail. They'll allow small ones to fail. So they've got an immediate advantage. The big banks will pay you a slightly higher interest rate on your uninsured deposit. And so they've already got that big advantage. The second advantage they have is they don't pay the premiums for the insurance on those uninsured deposits. So think about Silicon Valley. Most of the deposits are uninsured. They're not paying premiums into the FDIC. And then suddenly there's a crisis and, oh, we got to insure all of it now. Okay. So for all those years, they didn't pay those premiums. And then when the crisis hits, we raise the premiums on everybody to try to recover the costs of bailing out the uninsured deposits. Okay. So anyway, there are many reasons why uh, we do need to rethink the way that we treat the big banks, treat the banks. But the best thing to do is to get rid of the big banks. If they are systemically dangerous, they should not exist, period. So the answer to the dilemma of uh, Chase is it should be shut down. Okay. Don't try to increase the capital ratio, just shut it down. Say you are too dangerous to exist. We cannot have a $3 to $5 trillion bank. We're not going to allow it. Set a cap. Unfortunately, he is, if the Democrats win, he's going to be the Treasury Secretary. And if the Republicans win, it's going to be John Paulson, the guy who got $1 billion through Goldman Sachs. Goldman Sachs let him pick the mortgages to put into a mortgage-backed security so he could bet against it. Okay, he made $1 billion. He's going to be the Treasury Secretary if Trump wins. Either way, we're screwed.
Uh, we'll go on to the next question then. Eric.
Yeah. On that note, I was just going to point out the painting behind you. I used to have that framed as well.
Oh,
Makes you wonder, like, what exactly do we do about institutions that politically entrenched as the banks? Because it seems like that's what it would take to get them out of power. I mean, it's like the enmeshment of state and Wall Street is pretty astonishing, even to the point that it's the same actual people heading both institutions. So I mean, I'm kind of torn between two questions. One of them was just wondering, like, a lot of people around the election and Trump and so forth use the F word and talk about fascism and so forth. And I always wonder, is like, if this is fascism, like Trump is fascism, what about like what the banks are doing, where they literally, control the institutions they're supposed to be regulating? So I guess in that sense, I'm wondering how. I mean, this is kind of an impossible question, but you do speak about reform in some of your articles and kind of things that the left needs to coordinate or, at least aspire to in terms of, possibly inter imagining a political intervention for this, because that's something that certainly hasn't been there for the past decade or so. My other question, which is maybe a little too diffuse, but I was wondering how you understand the connection between 2008 if there is any, and the recent basic COVID shutdown crises, and sort of how the Federal Reserve and Treasury handled those two things. Sorry, I realize that's two questions, but
Okay.
yeah.
Yeah, you might have to remind me of the second question. I'll say a few things about what we should do. Well, first, it's probably impossible to reform the financial system after you have saved it. So uh, Roosevelt came in, and his first act was to close all the banks. So he called it a banking holiday, which sounds better than saying we're going to close all of the banks. Nice little holiday. And then he put Jesse Jones in charge of determining which ones to allow to reopen. So this is a Friday, and by Monday, I've forgotten the numbers, but I think almost half of the banks were allowed to reopen. Um, and then Jesse Jones demanded resignation letters from the heads of every other bank. Okay, he said, "I want to put them in my drawer, and if I need them, I will pull them out, and you will be fired. Okay, you'll be gone." And a lot of the banks he did shut down. I think maybe a quarter, and he put his own people in charge of those to try to operate them. And then they turned most of them around. And in the end, the Treasury actually made money on the whole thing. Okay. Which I don't think is important, but politically it's nice. So in the end, you saved the financial system and the Treasury made money doing it. Okay. Compare that to what we did before. Okay. And they put the financial system back in its proper place, relatively unimportant. That's where the financial system should be. It shouldn't be very important. And it was safe for a whole generation. Uh, so the lesson that you learn from that is you have to do it in the crisis. If you save them first, forget it. It's not going to happen. So I think Obama could have been a pretty good president, but the problem is that he did it the reverse. He had Timmy Geithner and he had Paulson providing the advice on what to do. And so they chose to save the worst institutions. And they and we did lose a lot of banks, or we've been losing banks steadily uh, due to failures, but also due to consolidation. So we've ended up with a system that's more consolidated than it was, which is exactly the opposite of what we needed to do. So you probably have to do the reform in the depths of the crisis. That's when you can do it. So what could you do in the crisis? I already said regulate by function. Okay. So everybody gets treated the same if they do the same thing. And protect consumers first. Most important thing, protect the consumers. And what that means is that you limit who a firm like Goldman Sachs can screw. If they screw only rich people, you know, who cares? You don't let them screw people who aren't rich. You don't let them screw around with important parts of the economy. You don't let them monopolize the aluminum supply. Um, so you protect the economy from them because they're dangerous. Um, you any institution that gets a bank charter. So in the U.S., we have a definition for what a bank is. They accept deposits and they make loans. So if you do those two things, you are a bank, and you have to have a charter to do those things. Um, if they're going to do that, then you say nothing off the balance sheet. Everything has to be on the balance sheet. Okay. No marketing of your assets. You got to hold the assets on your balance sheet. Uh, that will greatly reduce the danger and simplify the system, make it easier to regulate and supervise the banking institutions, um, and eliminate a huge portion of the financial system. You need a class of institutions that are narrowly focused on um, their customers and serving their customers, um, that are inclusive, that bring everybody into the banking system. I think the United States, we still have about 25% of the population that's unbanked. Uh, we need to include everyone into the banking system. So you need a special class of institutions that can do that. It could be uh, like the old savings and loans, small local uh, private banks, or it could be public banks. It could be state banks. It could be the postal savings banks, something like that. Our every economy needs those, and we used to have them. We used to have both the postal savings banks and the thrifts to serve that purpose. We need to rein in private equity. The big danger now is private equity. They're gobbling up everything. They're gobbling up all the rental units, right? So making housing scarce. So we need to clamp down on private equity, um, and limit the use of particularly dangerous kinds of products like credit default swaps. Why should anyone be able to place a bet on failure and then try to operate in a way to make sure you will fail, which is what credit default swaps are for? Um, so if someone wins because you lose, we should prohibit that. Uh, we're now letting, right now, supposedly only foreigners, but we know Americans are doing it, betting on the election outcome, right? Okay. And that itself is influencing the election. This is crazy. We should not allow that. Um, there's all sorts of kinds of bets that should not be allowed. There's all sorts of kinds of insurance that shouldn't be allowed, like death settlements, so-called peasant insurance, betting that your employees will die earlier than the statistics say that they would. That should just be illegal. Okay, so a whole class of stuff should just be outlawed. And then finally, we we should get rid of this insured deposits, uninsured deposits. If you're a bank, you must insure all your deposits. Just make that really clear. Make them pay the fee, the premiums, and insure all of the deposits. And we raised the limit to 250. That sounds a lot because you're always thinking of a household, right? But it's not for profits. It's firms. In the case of Silicon Valley, it's Silicon Valley firms that have huge deposits, and if they're in a bank, they should just be insured. So those are all reforms that I would try to make. Now, what was the second question? I did forget.
Oh, it is unrelated, so I mean, I'm good to move on. We can get to Bradley's question.
Okay, we can get back to you, Eric. Bradley, go ahead.
Yeah, sure. Thanks for you guys can hear me, right? Thanks for coming to talk to us, and I really enjoyed the PowerPoint. We talked to Michael Hudson a little while ago, and the topic of debt cancellation and jubilees has been, I don't know, it seems like a nice idea, right? And I also noted that this is, kind of away from regulating the banking industry, the jobs guarantee, employer of last resort piece that you mentioned. Where do you have any thoughts on debt cancellation, and where would that fit in along with the jobs guarantee with these institutional reforms? Or I guess maybe would really either of those do anything without the institutional reforms? Are they both necessary as like a full package? The political will kind of notwithstand, ignoring the lack that there's probably not political will to do it unless there's another crisis to that we can kind of use as an opportunity to reform.
Yeah. Yeah. So yeah, we don't have to wait for a crisis and get the major reform to do a lot of good things. So firms have debt relief. It's called bankruptcy. And I think it works reasonably well. And I don't know, back when I first started teaching, the business school told me that the on average, uh, individuals who become millionaires go bankrupt 5 times before they become a millionaire. Now, probably it's 10 million now because the inflation and all of that. So we allow firms to do it. You know, who isn't allowed to default on their debt? Well, student loans and home mortgages. So the laws were changed to make it really, really difficult to get out of the two kinds of debt that normal people have. So we should make it relatively easy for regular people to declare bankruptcy, and it shouldn't screw their lives up for the rest of their life. We let businesses get away with it, and then you go on to become President Trump after going bankrupt who knows how many hundreds of times, right? Um, so I think that that's relatively easy, just in the sense, all it takes is a law. Okay, say, yeah, you can declare bankruptcy. Uh, but dealing with the student debt, the Levy Institute has a major report on student debt relief and how what the benefits to the society as a whole would be. Uh, I think that we should eliminate uh, student loans from the private sector. They should come from the government. If we're going to make debt part of a college education, which we do, uh, then the loans should come from the government, and they should be modeled more like the British system, where the maximum length of time you're going to make payments on your student loan debt is 10 years. And the maximum is set a maximum to the amount of your income. They can go toward repaying debt, say 5%, 10%. Uh, then and then you're free. You pay 10% of your income for 10 years, you're done. Okay. And if you go into a profession that requires $500,000 worth of debt, okay, in 10 years, you're done and you walk away. And an income lower level. So if your income's below, say 40,000 a year, you don't make any payments. Okay. So it's only once you are successful with your college degree do you ever start making any payment, and you only pay for 10 years. So something like that to give relief to students. Now, far better would be to have a public education system where college is free, like most countries in the world. But um, I'll admit it's a little bit difficult uh, given our public-private. I'm at a private college, which is very expensive. Um, and it's hard to figure out how you're going to say, hey, Uncle Sam, we want you to pay $65,000 per student so they can come to Bard. There are issues to deal with there.
If I could ask another question myself, uh, we've studied your works on economics in our reading groups, and one thing we found is that at least among people who consider themselves to be critical of Marxism, or sorry, of capitalism, so Marxists, socialists, and so on, uh, we see that there's a lot of resistance or even hostility to thinking about financialization, the FIRE sector, Keynesian economics, and MMT especially. So one example I could cite is Doug Henwood's attack on MMT and Jacobin. I'm not sure you're aware of that, but I think a few of us here are aware of it. So my question is, why do you think there's so much opposition to MMT and Keynesian economics, um, or the idea of a specifically financial kind of capitalism among leftists
Mm.
and anti-capitalists?
I'm not sure I know the answer. Yes, you know, before MMT, um, uh, Doug Henwood, I think, was pretty aligned with the stuff that I was doing and others at the Levy Institute and post Keynesians. Um, So I'm not sure exactly what the complaint is. I can't figure it out. Um, I guess because uh, the very simplified version of MMT is, government can afford anything, therefore, we can have full employment and everything is going to be hunky dory and we don't need to worry about anything. Um, which is not what we're trying to argue. Uh, what we're saying is the problem is not economic in a very narrow sense of affordable. Okay. The problem, all the political problems remain, and they are tremendous. But if we can get through Obama saying, "Oh, we really would like to do more, but we ran out of money," um, and just have everyone stand up and say, "Hey, we know you are lying. That is not true. You can't run out of money. Give us some other reason why you don't want to do it." But we know that isn't it. Okay. Say, well, my Wall Street handlers don't like it. Okay, fine. Then we find another president who isn't beholden to Wall Street. But the problem cannot be that you ran out of money. Okay. So that's what MMT is trying to do. And there are people, everyone who supports and uh, contributes to MMT has many other things they're interested in too. And some of them are more interested in the politics than others. Some are more interested in, say, developing country problems, where again, uh, I've given lots of talks in South America. Uh, and in every country that I go to, the problem is not really economics, it's politics. It is that the elite doesn't want the economy to be better for the majority of the population. That's the problem. And unfortunately, the U.S. is more like a developing country than the other rich countries. Uh, we don't want the bottom half or two-thirds of our population to have a better living standard. That's the problem. It's political. It's not economic. Uh, Obviously, the U.S. can easily uh, produce everything that's needed to completely eliminate poverty, homelessness, lack of medical care. We can easily, technically, and with the know-how and resources we have, we can eliminate those extremely quickly. Okay, why don't we do it? They say, oh, we don't have the money. But we know that's not the problem. And I think most of them know it's not the problem too. They just can't say it. And over the past 25 years, we have sat down with elected representatives or their economists, explain MMT, explain the job guarantee, and they say, yeah, I get it. I can't possibly say that in public. That's the response. Can't say it in public. John Yarmouth was the first one to come out full blown and tell the truth. He said, I met him in his office. He was head of the budget committee, the Democratic head of the budget committee. And he asked me to testify before the budget committee. But beforehand, I sat down with him. He got all of it, completely understood it. And he said, don't worry, we're talking about all of this. And at least the Democrats all get this. So he said, it's not just me. We all get it. But he didn't tell me this, but I knew. They just can't say it in public. Um, he started saying it in public, and then he didn't run again. I don't know if those two things are real closely connected. That he knew he was not going to run again, and therefore it was okay to say it publicly. Um, but we've had that kind of response many times over the years. And what I learned is leaders cannot lead. they need someone else to get out in front. And once it becomes okay to say it, then they will be willing to say it. And so that's what we're trying to do. We're trying to get a huge body of people, voters, who will hold them accountable, the media, um, that that understand what we're talking about, so that it will become safe for politicians to say it. But obviously, we're still a long ways away from getting to that point. Even Bernie wouldn't say it in public. And he had Stephanie Kelton as his top econ advisor. And so he knows it all. He knows everything. She had dinner with him all the time, but he still couldn't say it in public.
Eric.
No, I already went, I think.
You had
Oh,
a
if you
question about COVID, I think, Eric.
Oh, yeah. What was that?
Oh, right. Well, I was just, this is kind of, I don't know if it's that well formulated, but I was wondering how sort of like the Federal Reserve policy from the 2008 era is sort of continuous with what was going on during the
Yes.
COVID pandemic era.
Yep. So, there's a good side and a bad side. The good side is the Fed learned how to ensure we don't get a 1929. Okay. So you go in unlimited. Draghi said, you do whatever it takes. Okay. If it takes 29 trillion, you do 29 trillion. If it takes breaking the Federal Reserve Act, doing things that are illegal, which the Fed did, they will do it. Okay. So what that means is that it may be impossible to get a Great Depression. Okay. Minsky always wondered. He put together a bunch of his articles in a book. Can it happen again? His answer was no. But in the 80s, he changed his mind. He said, wow, it might happen again because the system had gotten so dangerous. But after the global financial crisis, the Fed has figured out how to prevent it from happening again. And they acted very quickly with the Silicon Valley. And there were three banks, remember, they had to save. And it works. It's effective. So they stop it, they nip it in the bud. It doesn't spread through the system. Uh, our our banks, not my calculation, by financial analysts, including a friend of mine who's a very strict monetarist, extremely conservative. He says that now things have gotten better. The banking system is only $2 trillion insolvent. So they don't have capital ratio. It's 2 trillion in the hole, negative capital. And those are mostly the big banks. And it's largely the commercial real estate market, plus the mortgage-backed securities that have all tanked because of the Fed's interest rate hikes, and treasuries have tanked because of the Fed interest rate hikes. If you're earning 3% on a treasury or a mortgage-backed security, you're taking a huge loss on the value of that thing. So anyway, um, we're in a very uh, potentially very dangerous situation, but the Fed won't let it happen. The Fed is making massive losses. Okay, it's taking that stuff onto its books, and it is lending against the bonds as if they were worth original face value, which they're not, because they're only earning 1% in the case of some treasuries. So the Fed is also massively insolvent, which is different because it's government. So that's a sort of a legacy of the global financial crisis. If you go big, you can prop up the financial system and keep it working. And then what you do is you hope the economy recovers, and gradually the banks recover. So that's the hope.
Oh, that's interesting. So would you, maybe this is a quick question, maybe not, would you describe the global financial crisis, at least in America, as a depression, or was it, um, okay, it was a recession?
Uh, the COVID recession was the quickest, deepest one we ever had. But the global financial crisis lasted for years and years and years, spread all over the world. Uh, Europe had it even worse than we did because of the way the euro is set up and because you couldn't use fiscal policy. You only could use uh, ECB. So you couldn't do anything to rescue your economy. In the United States, we did something, and we had a jobless recovery. Things were bad for a long time, but no, not a depression. Um, and the COVID, of course, $5 trillion, which sort of proves to you that policymakers actually understand you can't run out of money. We spent $5 trillion with no pay for. No one proposed, well, we ought to pay for that spending with some kind of a tax increase. No. Or spending cut somewhere else. No. Just $5 trillion. We spent it.
So how sustainable do you think this dynamic is? Do you think that, the Fed can just keep on pumping money into the financial system? Or, I mean, where do you see this going in the next, year or two or 5 or 10 years?
The it has added to our inequality problem. So inequality has increased. The um, the benefits largely. Pavlina Cherneva, my colleague at Bard, has a famous graph where she shows every recovery since 1960, a bigger share of the growth of income goes to the top 1% or the top 1/10 of 1% or the top 10%. Doesn't matter how you divide it up. It always goes to the top. And so that continues to go on. And, what do we see? Well, we see that a convicted felon could be the next president. Okay. Um, because people are pissed off. So again, it creates a huge political problem that we keep sustaining the financial sector, which is where most of the profit, well, at least 40% of profits from my graph. I don't know how much has changed since then, but the profits are going to the very top. The share of income um, has shifted away from wages to profits and to other kinds of rents. Uh, so inequality has increased. The US is falling behind the rest of the developed world and falling behind China in all the ways that matter. Um, and that's going to create a problem where, sure, we can find the money, we can save the financial system, but we can't produce for our own population. We can't compete in international markets. I think that's where we're headed. And the financial system is not interested in that stuff. They can make more money in finance than they can in financing actual production. That's a big problem. So how can we increase our productive capacity and take care of our population when the financial system doesn't really want to do that?
So if I understand your response correctly, yes, the United States can keep the economy basically stable over the medium term, but and as a consequence, that the people will become increasingly impoverished, and the economy as a whole will lose the productive power to compete against its international rivals.
Yeah, I don't like the term rival. I don't see other countries as rivals. I know that that's really popular in both in Democrats and Republicans. China is not a rival. We should be working with China. Uh, we need to try to save planet Earth, and we can't do it without cooperation among countries. We need to work with China. We need to work with Russia. We need to work with India, Brazil. Um, and so we should all be cooperating. And climate catastrophe is the most important thing that we face. And there is no way that countries can go about this individually. Uh, the the rich developed world has created most of the catastrophe, and we have the capacity to provide what is needed to the developing world so that they can develop without continuing to destroy the planet. Every one of us use fossil fuel, and they will use fossil fuel too, because it's the easiest way to do it, easiest and cheapest. So without us cooperating to supply them with alternative energy, they won't go that route. So anyway, we all have to work together. And yes, the U.S. citizens will suffer if if we fall further and further behind the developed world in our capacity to produce. Biden was sort of on the right track. It was too small, and a large part of the funding that he made available still has not been taken up. Um, so we're falling farther and farther behind. Both the deadlines for uh, turning things around, but falling behind. We are so far behind China, so far behind in almost everything that matters. And it's not because I want to be a rival. I'm just saying that yes, China uh, can supply a huge part of the world with its output, but all of the industrialized nations should be moving toward green and advancing our capacity to produce so we can change the whole planet. Yeah, so yes, there are, of course, a lot of green industry people who obviously will benefit, and but they really want to change things. Um, I I don't know AOC, but I know people who work with her and have been promoting and advising her. And there are people like that who are in elected office who know what they're doing, and I think who have uh, good goals um, and good strategies. I'm not involved in any of that. I back in I think 2014, I was on Bernie's financial advisory committee. So was Stephanie, and I think that's how Stephanie got chosen to go to the CBO. Um, and he's tremendous. And I think in a fair election he would have won, but um, we know what happened in the primary. So uh, there are individuals, but it's just not an area that I can say much about or have any influence on. When they ask me to testify, I do it. Um, when I can get a meeting with any politician. I had a meeting with Kucinich, and I tell you, he was probably the quickest mind I ever came across. Uh, went into his office with Pavlina. He said, "What's this about the job guarantee?" And we gave him a 25-second summary. He said, "I got it. We'll do it. But hey, let's talk." And so we talked. He called in his assistant. He said, "Hey, start writing a bill for the job guarantee." He said, "Okay," and sent him out to start writing it. And we sat and talked. Brilliant guy. And of course, they redrew the line so that he couldn't win. So it it's depressing. It's difficult. Politics is difficult. I have no expertise uh, or advice on how you do it, except to just don't take dishonest answers, um, and don't don't continue to support the candidates that the parties want to give you. Demand something better. We know from Michael Moore does the survey to find out, what the majority of what kinds of policies the majority of Americans want. And it's like a wish list. You know, the majority of Americans are already there on all those things. And we knew from, I think it's YoungGov does polls of young people, vast majority support the idea of a job guarantee. So the kinds of policies that we want are already supported by the majority of Americans. They're just not put forward by the politicians. I suppose because the funders of the campaigns don't rank any of these things very high. So we have to somehow get candidates like Bernie, who doesn't worry about the funding, or AOC, who can get funding from the voters and get enough funding to win. Um, Ideally, you would want to get money out of politics, but you can't do that unless you start winning elections. Observing on the outside and looking at the polls of voters and so on, I mean, most Americans aren't happy with either choice. Okay. Um, Historically unpopular president sitting right now, who couldn't even run again because he was so unpopular. And uh, even a large percent of the people who are going to vote for Trump are not happy with Trump. It's just they're even unhappier with the Democratic candidate. And on the Democrat side, it's exactly the same. That they're very unhappy with Trump, and so they will go for Harris. So I personally would like to see uh, at least several parties that have a chance of winning elections. Um, and I think that would be very good to break this duopoly where a serious candidate can't run uh, except for one of those two parties. I think that this is a big problem. And there's no law, there's nothing in the Constitution that says that we have to have a two-party system. Um, the two parties, of course, like it that way because they know exactly what they're competing against, and they only have to be a tiny bit different from the other one in either left or to the right, depending on which party. Um, and so they don't have to offer much that the population wants. They just have to offer a little bit more to their 50% of the population than the other guy is offering. Uh, so I think that's why we can't get good policy because there's not enough competition uh, from third parties. So I my strategy is where you can vote for a third party, do it. And I'm lucky that most of my life I've always lived in blue states where it's not really affecting any outcome. I don't feel guilty at all about voting for Jill Stein. I advised Jill Stein. I talked to her on the phone for 2 hours. I advised her on student debt, and she's very good. I liked her position on a lot of stuff. Um, but if you're in a state where the third party might throw everything to Trump, then probably you're going to feel differently about that. But I would like to have legitimate third parties that have a chance of winning. And there are places in the country where a third party does well in local politics and state politics. And if that can grow, then we would have some chance for it.
We can end there. We're at time. But thank you so much, Professor, for your talk. It was a very interesting discussion. Thank you, everyone who came.
Okay, thanks.
Arise, ye workers, from your slumber. Arise, ye prisoners of want. That's right. For reason in revolt now thunder. Chains of hatred, greed, and fear. Ha ha! Away with all your superstitions. Serve our masses. Arise, arise. We'll change henceforth the old tradition and spurn the dust to win the prize. So comrades, come on and rally. Then the last fight let us face. The International unites the whole darn human race. So comrades, come on, let's go rally. And the last fight let us face. The International unites the whole darn human race. No more deluded by reaction. On tyrants only will make war. The soldiers too will take strike action. They'll break ranks and fight no more. And if those cannibals keep trying to sacrifice us to their pride, each at the forge must do their duty, and we'll strike while the iron is hot. So comrades, come on, let's go rally. And the last fight let us face. The International unites the whole beautiful human race. So comrades, come on, let's go rally. Ha! And the last fight let us face.